What is up, guys? It's BGFX. Welcome back to the channel. I hope you guys are all doing good. In today's video, what I want to talk about is going to be a very special concept I've never talked about on the channel yet, and it is going to be what we know as the Wyckoff Theory, right? The Wyckoff Theory is basically what you can call the origin of institutional trading, right? It's probably the start of it all. I'm not too sure the exact date that this was actually created or founded, but it was founded by Richard D. Wyckoff. Now, this is a strategy that takes a little bit of time to get used to, but once you get good at the strategy, your entire perception of what you see on the charts is going to change, and I mean that in the best way possible. But once again, it takes a little bit of time, but if you're willing to learn it, this will absolutely change the way you view the market. So I have a few screenshots here of what we call Wyckoff schematics. So this is going to be accumulation schematic number one. And this is basically what it looks like. Now, one thing I want to get out of the way is that when this theory was created and when this approach to trading was created, it was created around stocks. So the difference is, of course, we trade Forex. If you're watching this channel, you most likely trade Forex. So in my opinion, when you're looking at the schematics, you're not going to see the entire schematic play out every time. But once you understand the overall concept of it, and once you have experience, you can kind of mold it to the way that you like to trade. So in this case, right, you see how we have 5 phases. You have phase A, B, C, D, and E. And then in each one, you have different forms of market structure. You have different terms. You have your selling climax, your automatic rally, secondary test in phase B, spring test, sign of strength. That's pretty much what all of these little acronyms mean. Now, when it comes to me trading Wyckoff, I don't really look at the phases because, in my opinion, based off of back testing, it's not likely that every single phase is going to play out. Now, don't get me wrong, they will play out, but more often than not, you'll have little bits and pieces of each one. So my recommendation is, once you start trading Wyckoff, look at the overall structure and look for these exact things to happen. And then once you get a good view of how these phases play out, you can start kind of condensing them into smaller forms of market structure, if that makes any sense. So that's accumulation schematic number one, and this is number two. The only difference between number one and number two is that you have a spring in one, you don't have a spring in two. So the overall theory is that the market becomes oversold and overbought. So you're going to have what you call an accumulation and distribution. So basically, the market is going to start in an accumulation area. It's going to mark itself up. At some point, the demand is going to become greater than the supply, and it's going to cause a distribution, and it's going to push it back to the downside, right? So accumulation means that you'll be looking for buys. Distribution means that you'll be looking for sells. And then, of course, after each move, you'll have that directional shift in one direction. So what I have right here is NZD USD as well as GBP Jpy. So I'm going to be showing you guys an example of distribution as well as accumulation. So let's go ahead and kind of draw out some simple structure here just so you guys can get a basis of how Wyckoff works. So let's say the market is moving in a downtrend and you have this overall structure here. Now, we know, of course, that the markets don't really move this perfectly, but this here, right, this zone as a whole is what you would call your accumulation. And when using Wyckoff, you would pinpoint area, or you would pinpoint a particular way of catching that markup out of the distribution. Out of the accumulation. And then once the accumulation occurs, you're going to have what you call the distribution, and that's going to mark back down. So we know it's not going to look this perfect every time. Markets are always different based off of the setup, based off of the way that each particular currency is moving, but this is pretty much what it's going to look like. Now, you're going to have special rules that you're going to be using to actually get into each side of the market, but that's pretty much the basis of things. So starting us off with NZD USD, I'm going to show you guys the way I like to trade Wyckoff and kind of how I approach it in the market. So I like to look at this on a higher time frame, but keep in mind, Wyckoff is going to show up on any time frame, right? So whether it's the 1 minute, 3 minute, 5 minute, 15 minute, hourly, 2 hour, 4 hour, daily, monthly, it'll show up on every time frame, right? It just depends the way you approach it, whether you want to trade for the long term, shorter term. You can always identify Wyckoff on a higher time frame, and then what you could do is go ahead and work your way down to the lower time frame for extra confirmation, right? Because the market moves in fractals, right? Essentially, what you see on the higher time frame usually will align with the lower time frame, and that's how you get your entry. So what I want to do in this video is I want to change your perception of the way you look at the markets based off of simple Wyckoff. So what we have right here is an overall trend moving to the upside and then we finally make, you know, what most people would call this double top. So if we go ahead and we measure this, we can see that this happened for around 23 days. The market made a very simple A, B, C pattern up into these highs. Now once we kind of form this double top, of course we're going to have what we call liquidity, right? Actually, let me go ahead and use this, right? This is what we are going to call liquidity, right? Liquidity is going to be any type of order or any type of money that resides around an area on a chart. So when you're looking at charts, a lot of people like to see support, resistance, trend lines, moving averages, Fibonacci, and things like that. Now don't get me wrong, those work, but besides that, without using any indicator, you can pinpoint where orders are sitting at. So the market likes to move based around particular order types, based around liquidity. It likes to target different areas because we know as retail traders, we are not the highest form of, you know, money in the market. Our liquidity is usually preyed upon by bigger money, right? So what we have going on here is this high being made, and we have this double top. So what you're gonna want to call this, you're gonna want to call this the buying climax. Okay, it's gonna be the buying climax plus liquidity being formed around this area. So usually when it comes to trading Wyckoff, you're gonna have that first push, you know, in that direction before the schematic actually takes place. Now keep in mind, this is going to be a distribution setup, so we're going to be looking to sell based off of the structure. So there's going to be the buying climax, and then you're going to see some type of break of lows, and this is what we're going to call the automatic rally. So this is pretty much automatic, just going to be a reaction to a particular zone. And what you'll see is that after the buying climax happens, right after all these retail orders are being pushed into the markets to kind of extend that trend in one direction, the markets are going to kind of rally in the opposite direction, and what it's going to do is it's going to target the liquidity, right? It's going to target this retail money and the stop losses of people looking to sell around this time. So what you'll see is the market push to the upside, and very often it'll make what you call a secondary test. So what I like to do is I'll put ST right here, and it's going to make what you call a secondary test. So we're on a 2-hour time frame, but if we go down to the lower time frame, you could see that around this area here, we retested, you know, potential area of supply, and we rejected, we can go ahead and measure this out, around 23 pips. So this will be our secondary test, and then after that you have what is called the up thrust. So the up thrust is going to be a push above the buying climax. So the previous highest point of where buyers were in control before rejecting, the up thrust is going to come up and it's going to push above that level, right? So up thrust, UT, right? And that means that liquidity around the structure is going to be taken out before pushing back to the downside. So what we actually have here after our up thrust is an area of accumulation. So this accumulation, right, is not necessarily part of the Wyckoff schematic, okay? Not necessarily part of the Wyckoff schematic, but it's something I like to use just as a form of kind of understanding liquidity and things of that nature. So this accumulation is not the same type of accumulation here, right? This is just, you know, in the middle of structure. So what we have here is accumulation, and when the market is moving side to side, it's most likely going to be accumulating orders. And what you'll see that what actually happens here is that the market pushes down, it grabs any orders here and pushes back up above these highs and grabs any liquidity around this area. So essentially what you're doing with the Wyckoff theory is you're capitalizing on the manipulation of the market. Now the reason this works so well with Forex, once you get the hang of it, is because Forex is the most manipulated market. Now I'm not sure how many new people I'm going to have watching this video, but basically all these concepts such as support, resistance, you know, etc., trend lines, it's very widespread. So the market likes to target people and kind of prey on people and their liquidity who trades these methods, right? So what we have here is our accumulation. We have that push to the downside, grabbing those orders, push to the upside, grabbing those orders. Any stop losses around this area will pretty much hit. As you can see, 21 pips, and then right here 39 pips. So what we have is this accumulation, kind of somewhat you can call it contraction, expansion into new highs. So far we have our buyer's climax, we push to the downside, break lows, right? We have our automatic rally, secondary test, and up thrust, grabbing that liquidity, accumulation, hitting both sides of the accumulation, and then from that point we're gonna have our up thrust after distribution. Okay, so this entire area right here is what you would call distribution, right? The market kind of pushing in a different direction, gathering different orders, buy side liquidity, sell side liquidity, things of that nature. So keep in mind, within this, you're also going to have what we call supply demand, right? Supply demand. So you would have supply around this area, probably some demand around this area. So really quick, we're talking about things like support resistance. You're going to have those break and retests, things of that nature. So let's say, for an example, you have something like this occurring. Below this level, you're going to have tons of liquidity. You're going to have tons of stop losses, tons of limit orders around both directions. So when you're talking about this, when you're talking about support resistance, you're talking about very, very widespread zones that pretty much everyone sees, and most retail traders are being very active around this zone. So the difference between that and Wyckoff is that you're looking for very, very fresh areas. Okay, when we talk about supply and demand, let's go ahead and say that something like this happens. Let me go ahead and redraw that. We make a high. Instead of coming down and making any type of equal lows, we're actually rejecting before that equal lows takes place, because there's a high excuse me, a high amount of demand near that area. So from this point, right, once we kind of make this new high and we have that up thrust after distribution, you can see that we have new lows being made. Now this new low is what we would call our sign of weakness, right? So if we're looking to sell, you know, if this is a distribution setup, new lows will be a sign of weakness of price, which shows us that potentially the market can go from this overall uptrend into a potential seller environment. So this sign of weakness, we also see that there's potential area of demand here, and then also around this up thrust after the distribution, right? If we come down to the lower time frame, you can see that we have potential areas of supply and demand, or actually for the most part supply, since we are talking about these previous highs of the market. You're gonna have supply, right? And what I like to do is I like to box off this bullish candle before the market pushes to the downside, as well as this bullish candle right here. So when we're talking about, you know, what's going to happen here, we're going to have two possibilities, or should I say three possibilities. First possibility is that the market is going to push up, it's going to hit this first form, right, of supply, and it's going to absolutely reject from that area, and that'll be a short. Okay. Second possibility is that the market is going to come up to this high and it's going to push to the downside, and that's going to be a sell setup right there. Okay. Third possibility is that the market is going to say, you know what, forget it, we're not even gonna make this valid, and it's gonna push straight through, and it's just not gonna respect the analysis. So that is gonna happen, right? Regardless of what strategy you use, any strategy in the book, there's no such thing as a holy grail. Okay, so as an example, I'm gonna show you guys right here that the market actually rejects off of this first form of supply. So the way I would approach this, right, once I understand I have my full Wyckoff schematic and it's time for me to pull the trigger, what I would do here, right, is I would potentially take a short around this area, right, somewhere near the open of this bullish candle. I would put my stop loss very tight. Now when it comes to Wyckoff, you don't need wide stop losses. Okay, once again, this is a little bit different, so you kind of got to change your perception, because the widespread view would probably be to go ahead and put your stop losses above the high. But you know, that's the thing about Wyckoff. You're essentially building up different phases in the market so you can get in with the least amount of risk. And you're letting the accumulation, you're letting, you know, all these other things happen, and you're pretty much looking to get in at the best possible time, you know, before the market does its thing. Because the theory is that the market moves in certain phases, you know, in certain phases, and you're capitalizing on the beginning and end of each one. So we have right here is an 11 pip stop loss, right? I would not go with anything wider than that, maybe like a 13 pip stop loss. Now you might be thinking, you know, you said that the second possibility was going to push up to here. Well, if that is the case, aren't you going to lose your trade? You're going to lose the trade. So if market comes up to here, you'll be selling again with some type of confirmation on a lower time frame. Now the reason I'm okay with that is because if we look to the risk, look at the risk to reward, this is a 1 to 8.52 risk to reward. So if you win this trade, you're looking at somewhat of a 17% gain on your account, okay, with a very tight stop loss. If you're risking 2%, like I said, we always got to be using percentage-based risk, okay? Yeah, percentage-based risk, 17%. So if that is your return on this trade setup, I want you to compare that to your stop loss being up here with a 1 to 2.79 risk to reward. That would be like somewhat of a 5.4% gain. And then once again, if you lose this trade, that should be minus 2%. And then Next thing you would do is something like this, 1 to 9 risk to reward, and if you lose that, it'd be minus 2%. So I would rather take the 4% loss throughout the span of 2 trades rather than gaining, 5.7% on a trade that, had a very wide stop loss. Because once again, if my stop loss is this wide, it might play out right here, and then I have open risk that I pretty much took on with my positions for no reason. So the overall goal here is that I'm going to have a very high risk to reward. I'm going to have a very high gain, because this is open risk that you don't really need at the time. Okay, if you lose the trade and you get stopped out with 10 and 11 pips, you can always re-enter. But if you have a wide stop and the market's kind of fooling around right here and it comes up in new highs, once that happens, the Wyckoff schematic is pretty much going to be invalid at that point. So you want your trade to be validated, and you want to get in, at that time, and you want to have your risk near areas that's most effective for you. So my stop loss would be somewhere around here. Entry will be somewhere right here, and we can see if we can get entered. There we go. Entry would once again be somewhere right within this zone. Stop loss would be right here. We go ahead and press play and see how this goes ahead and plays out. So perfect. And then one more thing I want you guys to see is that the market likes to always target equal lows. Try to think of equal lows as areas where, once again, more retail orders are residing, right? We can see that there's a break and retest here. Very perfect. That means we can have some leftover buyers in the market. When something like that occurs, the market likes to target those zones. So this will pretty much be your trade based off the schematic. You would probably want to close around this previous area of demand. Once again, like I was talking about, the market will push up. It'll neglect to touch those previous lows, and it'll push back to the upside. So we have right here is pretty much lower time frame demand. You really can't check out the candlesticks too much on the 1 hourly. But you can see that this is demand. So the market tends to react to that same level. Once again, when you're trading Wyckoff, you're looking for a entire reversal with very low drawdown. So like I was saying right here, it's not very often that you'll see this entire schematic play out. For the sake of this video, I'm going to be showing you guys schematics that pretty much are very fundamental. But if you're looking to learn this, what I want you to do is go on the charts and look for the most perfect ones. And then once you get very used to the most perfect ones, you can kind of throw your own twist of things into it, So that's what we have going on here. And then once again, you press play, you can always target different forms of liquidity, even on the higher time frame. Like if we come up to the 4 hour, we can see that we had this little area here, and if we do have a lot of buyers in the market, it's very possible that essentially the market can push down, even come below these lows and begin to trade below there. So if we come over here, come down to the 1 hour, go ahead and see how it react. We could leave a little bit of our position open. It's very likely that the market will respond to these areas, but once again, it's all about initiation, accumulating orders, pushing them in a certain direction. So you can see that we are pushing below this area. Like I said, you can leave a little bit of your position open. If you did hold for the long term, this will be a 1 to 11 risk to reward, and that's not unlikely at all. When you're talking about something like a 1 to 11, you can even have 1 to 20s, 1 to 30s. When it comes to trading this method, man. So that's what we have going on. Very simple Wyckoff schematic. Like I said, it's going to take a little bit of time to get used to, but once you get actually familiar with the method, once you train your eyes to see it, it's going to be a completely different ball game. I'll tell you that much, right? So next is going to be Gbp Jpy. So we talked about this distribution, right? The market moving from an uptrend into a downtrend. Next thing I want to talk about is going to be an accumulation, right? And us pushing to the upside here, right? So we can see that overall the market was moving to the downside, and what we have here, right, was a previous area of supply here on GJ, and we ended up pushing down about 320 plus pips. And this was actually a trade that I called in the group chat. I told everyone I want to see GJ drop off of this area. Unfortunately, it was a break-even trade for me. Took my risk out of the markets very quickly. But once again, you live and you learn. That's what this trading is all about. So we have right here, this is going to be our selling climax. So we talked about NZD USD. Gbp Jpy is pretty much going to be the opposite. So instead of us having a buying climax right here, we're going to have what we call a selling climax, right? From the selling climax, we pretty much are going to have that reaction, and this is going to be our automatic rally of price, giving that reaction once it finds its low. And then if we go ahead and we draw this area out, we can see that this was an area of supply supply here on the 1 hour time frame, and then we had that rejection into equal lows. So if we go to NZD USD, we were talking about the upthrust, right? The market making that climax, giving us an upthrust, building some form of liquidity, and then giving us another upthrust after the distribution. So in this case, right, after this automatic rally in the supply, we pretty much have what you would call a down thrust, right? So this is a down thrust below these lows, maybe initiating more sellers into the markets. And we have this supply area firmly planted as an area of structure. And then what we have right here is a down thrust after distribution. So instead of it being an up thrust after accumulation, it's a down thrust after distribution. So once this occurs, what you want to be looking for is you now want to be looking for a pullback, right? And once again, this break of the low, you could call this a spring as well. You can call this a spring. This is kind of like your final down move before pushing to the upside. So once we come up, we make this high, we kind of form this little area of support. So that's what I want you guys to see. And for the most part, we're going to have liquidity beginning to build above the support. And what you can do, we'll go ahead and rewind the charts really quick back down to here. I'll go ahead and come down to the 30-minute time frame, and I will be looking for some sort of confirmation for why I would look to go long here. So if we go ahead and look here, we can see it as a potential area of demand. Some people will call this an order block, right? Market kind of consolidating before pushing back up to the upside. So once the market comes back to it, it's going to neglect to break those lows, and it may push back up here to the upside. So what I would do is I would go ahead and I would take Fibonacci from that low to high, and I would enter on the close of this candle, and my stop loss would probably be right below this area. And then take profit would probably be the 618, because once again, talking about liquidity, we said we had somewhat of equal highs being made here. So it's very possible that the market will push up and kind of target that area. So I'm going to tell you guys why I wouldn't target back up into these highs, right? We look at these highs, we really don't have any form of untapped liquidity. Once again, we had that supply, we pushed up, we retested it, and then from there, you're more likely to go ahead and just come up and kind of grab this liquidity at the 618. Rather than come up and make new highs. You know, it's good to hold your winners, but it's also good to understand when it's likely that your winners are going to be, you know, really running compared to when to actually just close them. So if we look right here, don't really have any strong areas. I would probably just target a few pips above here. So I would probably think, you know, where are people entering at, where are their stop losses, I would probably target around 20 pips above it, perfectly just like that. And then coming back to what we're saying, this is going to be your test. And now we are looking for a potential markup, and this was also somewhat of a demand area here on the lower time frame. So if we go ahead and we come up to the 15-minute, you can see that we had this gap once again that has yet to been filled. So that could be another form of confluence. And then if we go ahead and we go to our sessions, you can see that London session just opened. So that's another thing. You can trade Wyckoff, you can understand it, but you want to make sure you're entering your positions with whatever currency you're trading at the right time. You know what I mean? So you want to make sure that your session is right. You want to make sure that you're trading GBP, of course, during London, you know, looking for that breakout to the upside. So this is all a pattern. You know, when you're looking at the markets, you're looking at an overall finer things of movements going on, you know, accumulation, different things and different order types flowing in and out of markets. You know, it's not just about support coming down, breaking and retesting it and reacting. There's a reason behind everything, right? The market is ran very, very sophisticated. You know, it's more than just Fibonacci, moving averages. You can use those things, but when you have that perception change from, okay, everyone else is buying on this trend line, if I buy on it too, but supposedly 90% of people lose, how am I going to make money over the long term, right? So in my opinion, I think 90% of people lose, not only because of the risk management side of things, you know, from lack of psychological being able to take losses. I also feel like it's because of the strategy as well. You know, it's a bit of both in my opinion. So once again, we would want to see how price reacts to this previous area of supply. If we break through it, that would be perfect. So let's go ahead and see what price does. Once again, entry would be on the close of that candle on the lower time frame. Go ahead and press play and see what happens. And once again, getting a little bit of consolidation here, and then London breakout to the upside. We can see what happens, and there we go, perfect. And then I want y'all to pay attention to what price did here. We kind of peaked above this level a little bit, began to show reaction, maybe initiated some sells, and then we flew up back to the upside here around this previous wick before pushing to the downside. So that was a 1 to 9 risk to reward. Once again, risk to reward is very, very steep here. Super tight stop losses, but you're overall identifying the structure of the market. So that's what we have here. Gbp Jpy on a 4-hour. Once again, you always want to look for the Wyckoff schematics to happen on the areas of value, looking at the higher time frame. So if you look right here, very simple, Fibonacci from the high to the low. You would simply look at where price is right there near the 618, near that golden ratio. And once again, like the Fibonacci you learn, support resistance, it all works, you know, 618, but it's the concept behind it. It's the manipulation behind it, and understanding the cycles of the way that the market likes to move. Because you'll see, you know, the better you get at this method, you'll rewind the charts, you'll look at the markets, and your mind will just be blown, because you'll see how much the manipulation occurs, and you'll start to understand, you know, they say 90% of retail traders lose, but once you see why it actually occurs, everything changes, you know. So that's what we have going on here. 1 to 9 setup on GJ, and then a 1 to 11 setup on NZD USD. So the risk to reward is there. Like I said, be okay with losses, because your losses are so small, you know, compared to the overall reward here. So that is pretty much it, guys. It's been BGFX. Came at y'all a little free education today on the Wyckoff Theory. Like I said, banks don't want you to know this. Market makers don't want you to know this, right? So that's pretty much it, guys. Hope y'all enjoyed this video. It's been your boy BGFX. I'm out. Salute.